The market got really excited last week and really shifted a lot of outlooks. I'm not entirely sure that what they're shifting on is really worth that, and whether that's meaningful or not, we'll see. But just to give you an idea, I mean, we really didn't have, yes, the Fed said Powell said in the press conference that many of the members now don't expect rate hikes as much as they did at the September meeting. That's definitely true. We're having some good soft landing, Goldilocks type economic data. Some of the labor market data has sort of come off the boil quite a bit, although not enough to really lead the Fed to do any cutting or anything like that. So the market's kind of reacting. The marginal difference of expectations was at one level before last week, and after last week that shifted a lot, but it's not such a big change that you can really confidently say, okay, the outlook has really changed. And so we're kind of in between. We don't really have a full long-term context. If this was a bull market, a correction over signal would mean off to the races and new highs. I don't know that we're in one. If it was a bear market, the context would be cover your shorts and, lean on the long side short term, but look to sell short again. And I don't know that we're really clearly in a bear market yet. The rally may be either one of those or somewhere in between. So what I'd say is it's something you want to play. You probably want to play it less than normal strength. And you want to watch for indications that will tell us whether it has sustained power or not. I would say that expectations have shifted really pretty massively. Markets are now pricing in 90 basis points of cuts throughout the next year and 110 basis points of cuts by January 2025. That's a lot of cutting that was not priced in. Before, we were heading toward 50 basis points of cuts until the recent couple of weeks. So the market has really shifted a lot on a marginal shift in the outlook. The other thing I would say is, as we'll kind of look at, that from a macro basis, it's not really clear, and sometimes it isn't. You follow the internals, but there are a lot of increasing indications that credit tightening is starting to bite more, and in ways that can limit the rally and undermine economic growth. We saw 50% of companies in their corporate guidance this earnings season in the US mention weakening demand. That's something that basically the people who watch earnings releases kind of have a tally of words that people use. And that's one of the biggest phrases that they use this time. Generally, when that's one of the biggest phrases, you have a recession fairly quickly, or at least a substantial earnings growth decline. So there are some things that we really need to watch out for while we play with less enthusiasm than we normally would. We did come off, so the big impetus, of course, for the stock rallies was this big, we hit the 5% level. It's a big round number. It's not really a monthly resistance level, but it's an important level. And we came off it really sharply. Okay, we haven't really broken any kind of, if you can see, this rally has come up, come back down, really sharp decline back in July as well, came to around the 50 DMA, started bouncing again. We've had that a couple times. This time we came to the 50 DMA, we had a CGC up today. So we really kind of need to break on the TNX, break below last week's lows to say, yeah, this is a more significant correction than we've really had since the April lows. The market is interpreting this as something substantial. I think that if we play around in TNX, that can still give the market room to rally, particularly because sentiment is shifting so strongly. But we start getting up to 4.9 toward that 5 again, we've got the same problem again. And so we really want to be watching TNX rates